Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is September 11th, 2025. And today on our call, we have the CEO, Randy Boomhour from Cematrix Corp. Cematrix trades on the Toronto Stock Exchange under the symbol CEMX or CEMX and on the OTC under CTXXF. The company is currently trading at 28 cents with about 150 million shares outstanding, or about a $42 million market cap. And now I hand it over to Paul Andriola.
Thanks a lot, Trevor. Randy, great to have you here. We do know Cematrix very well. We've come to know the company over the last several years, but you're relatively new to the business, so it's the first time we've had you on here. So happy to have you here, and welcome. Listen, let's cut out the formalities. Happy to have you here. We want to get started with the presentation. I'm just going to hand it over to you.
Terrific. Thank you, Paul. Really appreciate that. Thank you, Trevor, for the great introduction. So as you said, Paul, many of your listeners or viewers have seen or heard of us before. So I'll go pretty quick through the stuff. In case there's someone new to the story, I will kind of cover the basics, and then we'll go into a bit of a question and answer. So hopefully I could do a good job here on my first time. Let's see how I do. So I won't cover the forward-looking statements, but I think all investors kind of understand those. Always kind of like to start with this slide, which is just a high-level introduction to Cematrix. And this is a slide that we cover on all our earnings calls. Essentially, we're an innovative cellular concrete solution company, leading provider of lightweight, cost-effective, durable cellular concrete for infrastructure projects. We have a strong competitive advantage that I cover in the next couple of slides, and we work primarily as a subcontractor for major North American general contractors. There's significant market opportunity in front of us. We're an industry leader in an industry that's pretty fragmented and pretty new. The cellular concrete market is pretty big. It's estimated in the billions and growing. It's obviously very hard to measure exactly how big it is, but we know it's pretty big. And then there's just a lot of infrastructure spending that's happening in Canada and the US that provides a strong tailwind in our key markets. We're really proud of our financial progress that we've made. We're in a position of financial strength with an overall growth trend. Our cumulative annual growth rate for revenue has been 24% since 2017. And I think sometimes that gets overlooked in our story that we are growing. In 2024, we did revenue of $35 million, EBITDA of just over $3 million, and had positive cash flow from operations. This year to date, as the end of Q2, we're at $17 million, adjusted EBITDA of $2.4 million, and cash flow from operations of $2.3 million. We have $8.6 million in cash and no long-term debt. And we're still forecasting a record year in 2025. So we're in a really good place in terms of executing our plan for this year and set up to have a really good year next year as well. From a management perspective, three key members of the management team now are myself, Jordan Wolf, who's the president of Mix On Site. Jordan came over to us when we purchased the Mix On Site company from his father, has tremendous industry experience right from the hose right up to the top of the organization. And MJ is relatively new with us, just over a year now in the CFO role. On the board side, we've got Manaz, Patrick or Rick, Steve, Anna, and John. So lots of experience there. Some of them have been with us for a very long time, almost since the start, and others are relatively new to the board in the last 5 years. In terms of outstanding shares, we have 150 million shares outstanding, fully diluted about 167 million. Insider ownership is just over 15 million shares, with Jordan having just over 12 and myself just under 2 at 1.8. I always like this timeline. I've been told many times not to present it because it shows that it's taken a long time to get where we're at, but I like it because it really shows the staying power of the company and the number of things we've kind of fought through to get to this point. And we really reached an inflection point in 2023 where we went from a company that was still more concept than company. We weren't consistently making money, weren't consistently generating cash. And in 2023, that really changed. So we're no longer having to go to capital markets to raise money to fund a burn rate. We now generate cash even on down years, and we're basically accumulating cash so that we continue to be more creative in terms of how we grow the company, potentially through acquisition. So for those of you who don't know about cellular concrete, it really is kind of an amazing construction material. It doesn't replace regular concrete. That's not its purpose. It's really a niche material. And when it works, it usually works because one of the properties of the material makes a lot of sense for the application. Cellular concrete is made by mixing cement, water, and a foaming agent. That foaming agent creates a bubble in the mixture, and that results in a cellular structure when the concrete sets. As a result of how it's made and the elements it's made out of, some of the key properties it has can be very cost effective against the alternatives. Has a low density and is very lightweight, which is really important. Has a high bearing capacity. It's extremely pumpable, which is one of the main advantages using it. It's highly flowable and self-leveling. It's self-compacting. It has some thermal insulating properties because of the bubble structure, and it's durable and excavatable. The primary applications of it is lightweight engineered fill, MSC retaining wall fill, lightweight insulation, flowable self-compacting fill, pipe and culvert abandonments, tunnel and annular grout, and shallow utility and insulation. So lots of applications. These are the ones that we focus on. There's many, many more applications for cellular concrete out there, but in the infrastructure space and the space in the markets we chase, these are the primary ones. So key customers I already talked about, we're almost always a subcontractor, general contractor. This does create challenges because we're almost never in control of the construction schedule. So I feel like I'm explaining often why we miss a forecast. It's because, the general contractor's behind or hasn't started. So that's a challenge. We're trying to get better at forecasting that and understanding our customers better to see when that'll happen. But we're rarely in control of the schedule. Occasionally, we will contract directly with an owner, but it's usually on a very small scope of work. And as you can see, we worked with many of the largest general contractors in North America. That's not a comprehensive list, but it's a good list to give people a sense for who we work for. So on the competitive advantage side, number one is our reputation. We've been successfully delivering cellular concrete solutions on budget and on time and on quality for over 25 years. Our team is incredible, really is the key differentiator. We have over 200 years of in the field experience. Our equipment, we really do have a large fleet of modern, advanced equipment to produce cellular concrete with a lot of capacity to grow. We could easily do twice to three times our revenue with our existing equipment fleet. We still invest in equipment because sometimes a specific piece of equipment will give you a competitive advantage in a certain market segment or market size. So it's not to say we won't have any CapEx, but we've got a lot of capacity to grow in our equipment. We are, to the best of our knowledge, one of the largest, if not the largest, cellular concrete company in Canada and the U.S. So that gives us size and scale opportunities that our competitors have a tough time matching. So we literally have multiple locations from coast to coast, and we completed projects both in Canada and the U.S. all over. And we're generally more sustainable, generally more environmentally friendly than some of the legacy products that we replace. So as I said, it's difficult to measure how big the market is. I mean, I think you could go onto Google or any search engine and try to search it up, and we've seen estimates from as low as $4 billion to as high as $27 billion. I'd say, in the markets that we chase in the US and Canada, our estimate is somewhere between $500 million to $1 billion. And there's a significant market for other lightweight fills, which includes competitive products, which is probably a multiple size larger than what I've talked about. We've also talked about infrastructure spending in Canada. In the US, there's a lot of infrastructure that needs to be repaired and replaced because it's aging. And then we have populations that continue to grow. And so then you have to do new infrastructure. And it's also placing additional load on existing infrastructure. So there's a lot of forecasted spending to come on infrastructure. And we really see that as a very significant tailwind for us. Obviously, not every project or piece of infrastructure work is going to have a cellular concrete component, but the more of these projects that are happening, the more likely you're going to run into some kind of abandonment or some situation where you need a grout or some situation where you've got a weak or unstable soil or some situation where you got to reduce the lateral load on a structure. All of these situations create opportunities for the use of cellular concrete. So company financials, do this real kind of quick. We've talked about this. So the top line growth trend, a lot of investors were upset with us in terms of the 2024 revenue where the trend line dipped because we had such a fantastic 2023. But as I mentioned before, the overall cumulative annual growth rate of the business since 2017 is 24%, and we're forecasting to have a record year this year. As I mentioned also, we have a positive bottom line. We're generating cash. and we've got a healthy balance sheet with very low leverage. In the past, we weren't really as transparent around some of the things that impact our business that I think is important for investors to understand. So one of them is that revenue growth will be lumpy. Investors love to see a staircase where, every quarter or every year you're growing by 5, 10%, whatever number you want to pick. But unfortunately, in construction, it just doesn't work that way. Our financial results are going to be variable based on the timing of when large projects start and stop. And so sometimes we'll see delay, but the overall trend is one of growth. And I'll show that in a chart coming up here. The other thing is for the markets where we have our largest presence, it's a seasonal business in construction. So as you see, we do about 18% of our revenue in Q1, another 18% in Q2, 36% in Q3, and then, sorry, I got my camera blocking here, the remainder in the fourth quarter. So you can see it's about a third of our business in the first half and 2/3 of our business in the second half. So very much weighted towards the second half, and that has to do with just construction cycles. We are a specialty construction contractor, so our margins are going to tend to be higher than general contractors. But unlike general contractors, we're going to have bench time where maybe we don't have all of our people working or all of our equipment working. So there's more bench time or more fixed costs that we've got to cover. Project size matters for a lot of reasons, right? We love large projects because it's a way to really kind of get a lot of revenue quick. But usually on large projects, and I shouldn't say usually, always on large projects, there's more competition. And as a result, the margins are tighter as a result of that competition. And I've chatted about it already, but we have excess capacity in our equipment that enables us to do significantly more revenue with existing equipment. And that could be easily 2 or 3 times our level of revenue. And then we have capacity in the staffing level, but not to the same extent. So if we were to do 2 or 3 times more revenue, we would need to hire more staff, but it's not double or triple the staffing levels that we have now. We might increase crew size by 20% or 30%. So a lot of leverage there in terms of capacity. So I won't cover the Q2 numbers, but if you look at it, it's just kind of all across the board up versus 2024. So we're off to a great start in 2025, and this is kind of the first quarter we're able to provide some numerical evidence of what I've been telling people for the last 9 months, that we're going to have a record year. So all across the board, you're just seeing good news here in terms of how we're doing. I like these charts for a bunch of reasons. That the one on the top right there really shows that overall growth trend that we've been talking about. And the thing that's interesting is you can see year to date in 2025, we've done about 17 million, which is the same as we did for the whole year in 2018, and pretty close to the numbers you saw in 2019 there, 2020, 2021. We're in the ballpark. And so it's really just more evidence that the business is growing, even in our slower quarters. The margin or the graph on the far right there, top right, is the gross margin graph, and we've been spending a lot of time talking about gross margins and trying to understand where we can improve gross margins, whether that's through better bidding, whether that's through better execution, or whether it's through better understanding of what situations should we get higher margins versus what situations do we have to be more competitive and actually maybe target a lower margin. But overall, again, significant improvement on the margin side, which is great. I love the chart on the bottom left as an accountant by trade. We really did lever up the company there to do the acquisitions for Mix On Site and Pacific International Grow, which transformed the company. But we actually showed a lot of prudence when we raised capital to pay down that debt. We were spending over almost $1.5 million in interest costs there at the peak. And so to take that out of the burn rate and to reduce the debt on the books and improve our balance sheet really has transformed the company and transformed our ability to withstand and survive economic shock events, which happen in all businesses. And then on the far right bottom there is just a cap table structure, kind of with some more details about the dilutive instruments. So I won't chat too much about those. So despite off to a great start, backlog is continuing to grow, and that's really a sign of a lot of success on the sales side that we've had early. And when you do a good job in the field, that kind of creates a success loop because it makes it going back to that customer the next time easier to get them on board with doing a project for you. If you do a bad job in the field, then when you come back to talk to them about the next project, they're not surprisingly less interested in that. So by doing a really good job for customers in the field, that makes selling easier, and it creates a success loop where we're able to sell more and more. So really happy about the progress we've made on the sales side. So just in closing, I always like to kind of cover off why invest? Because I mean, that's really why we're here. I mean, investors are obsessed with share price and with revenue growth. You know, as a person that runs a business, I'm obsessed with safety. I'm obsessed with quality, and I'm obsessed with making money. The good news is when I do those three things right, the other two things that investors are obsessed with, those go well as well. So why invest? We're an industry leader, so we really are well positioned to capitalize on the large opportunity for the growing infrastructure construction segment. Two, we're a growth company. We have growing revenue, positive EBITDA, positive cash flow, and a strong balance sheet. One of the things that's interesting, just to dive in on this one a little bit, is if you go looking for companies in Canada that have a market cap under $50 million, but are doing about $50 million in revenue with positive EBITDA and positive cash flow, you won't be able to find very many. When I looked, I could only find one, and it was us, right? So we're kind of in this really unique spot. We believe that we're currently undervalued based on traditional valuation metrics, whether you want to use a forward revenue multiple or a forward EBITDA multiple, we come up with a number that's higher than where we're at trading at today. I already mentioned because we hit this inflection point, we don't need to raise capital to fund a burn rate. So the only new capital should be in support of an accretive acquisition. And we've got existing capital today that we're looking to deploy. Ideally, we'd like to deploy that into an acquisition, but we're only going to do that if it makes sense. So we're not going to put ourselves in a box and say we're going to do an acquisition in 12 months because right now today I don't have a valid one or one under LOI, but I'm looking. And if we can find one that's accretive and makes sense, we'll pull the trigger on that and deploy that capital and help our growth strategy. On the far right side there is our investor relations contacts. We have the Howard Group for the retail side. We have the Bristol Group for the institutional side. And we are covered by an analyst, Russell Stanley out of Beacon, who provides some good information that can help investors. And so, Paul, that's really my presentation, my talk. Hopefully I didn't go too fast, covered the highlights, and I'm open for business.
Yeah, you did great, Randy. Appreciate it. Thank you so much. Reminder, everybody's listening, of course, if you got a question, please use the chat function and we'll fire it off to Randy here. Randy, you mentioned seasonality. I mean, common sense would dictate that, you can't pour concrete in all sorts of weather. So there's some of that you got to deal with. But how about cyclicality? Is this a business that is tied to any kind of cycles economically, or do we expect this to sort of weather any storms?
Yeah, I don't want to say there's no cyclicality to it. That would feel kind of dishonest. But one of the things that we love about the infrastructure space is the spending there tends to be less cyclical. So if investor confidence or retail confidence is down, governments are still constructing bridges or still repairing bridges. If there's a sinkhole that needs to be filled, they don't wait till the economy turns around, they fill it, right? So there's a lot of sort of natural defenses in terms of the infrastructure space and focusing on that as a business. So I really feel like we don't have a lot of exposure there. Clearly, if you were to get into some more terrible macroeconomic events like maybe what's happening in Ukraine, you could see how that could impact your business. But in Canada and the US, we obviously don't foresee or expect anything that would be anywhere near that.
Another question I was going to ask is really around your background. You're relatively new to the business. What's your background, and how'd you sort of come to be the CEO of Cematrix?
Yeah, so that's a really great question, actually. So I joined in December of 2020, so almost 5 years ago, actually, as the CFO. And even at that time, Jeff and I, when we were going through the interview process, he was chatting about succession because he kind of understood where he was in terms of his own plans for retirement and his own plans for, what his strengths were and where the company might need help in the future. Prior to joining Cematrix as a CFO, I had started a company, a catalyst handling company, actually based out of Alberta. So I'd had some experience as an entrepreneur, some experience starting a business and starting it from scratch and understanding some of the challenges. And everyone will tell you that, running a business is hard, starting a business is harder, but the reality is it's exponentially harder than what you think, right? It's extremely challenging, and I got nothing but respect for Jeff, for him to pull it off. Do you think about how many people could start a business out of their garage and turn it into something that does $50 million a year in revenue? So it's incredible. And then once I started at Cematrix, I was a CFO for about 2 years. And then in 2022, I added the Canadian operations to my portfolio. So I took over as general manager for Canadian operations. And again, that was part of Jeff and the board assessing whether I could run the business and handle the sales and operations side. And then in 2024 is kind of the next step of preparing. We added the chief operating officer role to my portfolio. And so that I did that for a year. And then Jeff announced his retirement at the end of last year, and I stepped into it. And so the good news is, like Jeff and I were very aligned in the strategy of the company and how we're going about things. There's some minor differences in terms of how we communicate, and maybe how aggressive or conservative we are in terms of our messaging to the markets. But we're very similar people.
Mhm. So $8.6 million in cash, roughly. Um, do you have the balance sheet you need right now, do you think, if you're going to go do more M&A? And what does an M&A sort of opportunity look like for you guys? I know you've done something in the recent past, but going forward, how would you describe what the M&A strategy looks like?
Yeah, I mean, our preference, strong preference, would be to acquire another large cellular concrete company in the U.S., much like
Mhm.
Mix or Pacific International Growth. Those would be the best. I would grade those as A opportunities.
Mhm.
Um, the secondary opportunity would be, if one of those are not available, would be to look for someone who does something similar. So it could be a
Mhm.
company that does chemical grouting in Texas, for example, where they would have similar types of customer base, similar type of technical sale in terms of, you got to be knowledgeable. You're not just selling a commodity, but they would have existing relationships where we could leverage and place equipment into that market, and then use those customer relationships to grow the cellular concrete market in those areas. So, markets like Florida or Texas strike me as kind of ideal for those types of situations. And
Mhm.
then the last one, the last type of tier of opportunity would be something like what we try to do with Glavel in terms of foam glass aggregate. So again,
Mhm.
another a lightweight material that has similar advantages to cellular concrete. Not all of them, obviously, but similar. And
Mhm.
try to find a way to invest in a business like that where we could again leverage what we know about the infrastructure market and how things are sold into it, but also add another product line. So that's kind of how we think about acquisitions and in terms of how we would approach it. And then I do think we've got the balance sheet to go at it. If we were going to do an acquisition, it would have a large component of cash, given the types of
Mhm.
companies that we target.
Mhm.
And then it would probably have an equity component, which is part of why we want to get the equity price fixed before we go do an
Mhm.
acquisition, because I don't want to be, giving away cheap equity as part of an acquisition. And then
Mhm.
we always try to include an earnout component so that we can basically hold people's feet to the fire in terms of what they think the future prospects for the business are.
Gotcha. Gotcha. And I mean, you're in such a different state as far as business-wise now than you were several years ago. So I imagine the challenges the business faces is quite different than what it was years ago. Maybe talk to that. What sort of keeps you up at night right now running Cematrix?
Yeah, and it's a really good observation, Paul, and one I think we're super proud of, right? We really did have an inflection point in 2023 where the nature of the business changed, right? And so we went from survival mode to a mode of around how do we profitably grow this business. And that's why I'm not obsessed with revenue growth. I'm obsessed with making money. And I think sometimes companies lose sight of, hey, it's so important that I grow. They just take more and more risk for less and less money. And we're just not interested in that at Cematrix. We want to grow profitably and make sure that if we're doing work, we're going to get paid for it, and we're going to make money on it. So what really keeps me up at night is I worry about safety. Like when I say I'm obsessed with safety, I don't want to ever have to phone somebody and say, hey, your husband got hurt. I really never want to do that. And so we spend a lot of time and we spend money making sure our people are safe and that they know that if it's an unsafe situation, they don't have to work.
Mhm.
I'm also really obsessed with quality. Like I honestly believe the best way for us to grow our company is to be the best cellular concrete manufacturer and provider for our customers. So when we service a customer and put that customer's needs ahead of our own needs, and make sure that that customer is happy, that's how we'll grow our business in the long term.
Mhm.
So in the short term, I may run into situations where I make less money on a project or I have to spend some money to make something right. But it's so important to keep that customer happy, and to make sure that the next time they've got a project, they call us. And so one of the things we track internally is we track the net promoter score for our customers. And our net promoter score is over 90%, 91%. We don't normally publicize that number or talk about it, but it's super high. And we're really proud of that internally. And that really speaks to how important that relationship with the customer is. So that I worry about quality. And then the last thing I worry about is I worry about making money, right? I want to make sure that when we're on a job that we make money and that our customers are going to pay us. So, and then I also spend a lot of time thinking about how am I going to grow revenue? Because we have a fixed cost base. We have enough revenue now where we can pretty successfully cover that fixed cost base every year and still be profitable. So then the question is, how do I take the company from 50 million to 65 million to 75 million to 85 million? So I spend a lot of time thinking about that, thinking about, where could we add a salesperson to help grow a market? Where's an opportunity that I haven't spent enough time on? Where's a company that I could call to see if they're interested in selling to us? So I spend a lot of time thinking about and wondering if I'm doing it right on how to grow the top line of the company.
So I sort of mentioned or asked what keeps you up at night, but what gets you up in the morning? What gets you excited? Maybe are there new initiatives that you're planning that you're excited about?
Yeah, that's a good question. I got to be careful I don't say something that's not public, but I will say I'm really excited about the acquisition side, Paul. Like I really feel like we've made some good progress on fixing our share price. We've had a bit of a backward slide here, but I think once Q3 results come out and people again see the evidence that we're doing what we said, I think it's gonna get fixed. And then I'm interested to see if we can convince somebody to join Cematrix and really help move this thing forward. So that's what gets me super excited is that opportunity to make a strategic acquisition like Jeff did back when he acquired Mix on Site and Pacific International Growth that really transformed the company, right? And so if we can find another acquisition or two like those ones, it's going to be really exciting for us.
And as far as capital acquisition, so you mentioned M&A a number of times here, but you also have an NCIB in place. How do you balance sort of those two things? Obviously, a higher share price would be helpful. A low share price is something you can take advantage of with the NCIB, but how should an investor sort of look at how you look at that?
Yeah, that's another really good question. Thank you for asking that, Paul. NCIBs are tricky, right? Because the press release says what's the maximum that you can buy, right? And so I think sometimes that misleads investors. And I'll sometimes see in the chat boards, which I check out every now and then, where investors will say, "Oh, the company's going to buy back 10% of the shares,"
Right.
and we're not, right? We don't have that much capital allocated to the NCIB. But I guess the other thing is I think sometimes too investors think about, companies do the NCIB to try to influence the share price or to push it up. And we don't believe that that's the purpose of the NCIB. The only reason we're doing the NCIB is to put our money behind our mouth to say we think the share price is undervalued. And when the share price is undervalued, we think that's a good investment to buy. And so we're using the company's money to do that. And the other thing is, traditionally for small cap companies, existing shareholders they're always getting diluted, whether that's by new issues or share-based, stock-based comp, they're always getting diluted. And so we thought it'd be nice for once to actually do the opposite so that we're actually not diluting shareholders. We're actually boosting the share count so that their ownership as a percentage of the total is actually going up, not down.
Fair enough. That's perfect. Okay, let's take some questions from the audience here. We've got some sharp guys, so express some sharp questions here. Rahil says, why doesn't Cematrix work directly with project owners instead of going through contracts or middlemen?
Yeah, I mean, we do talk to owners direct. We talk to design engineers direct. I mean, that's part of good business development. So when we're doing business development, we're not just talking to general contractors. But unfortunately, when work is let out, it's let out to a general contractor, and then those works that they can't perform or self-perform, they're subcontracted out to us. That's just the way construction works. It would kind of be like an electrician in a new house build trying to contract directly with the homeowner. It just doesn't work like that, right? You contract with the home builder. Now, if you're in the maintenance business, that's different. You could contract direct, and we sometimes do that, right? So if we work for like Suncor, for example, up in northern Alberta, where they have an existing facility and we do something there, we would contract directly with Suncor.
Yeah, that makes sense. Absolutely. Okay, the second part of his question says, since the most recent purchase order announcement was in July, could you clarify whether the company's practice is to announce only larger purchase orders while smaller ones are not typically disclosed?
Yeah, so we have an internal threshold. So like every week we're winning work, right? So it's not like if I don't do an announcement for 2 weeks, it's not like we're not winning work during those 2 weeks or 2 months. Base of the threshold we use internally is about $5 million. So as soon as we have enough wins that amount to $5 million or more, then we do a news release to disclose those. So that's really our process. And when we do those wins, we include the big ones, but we also include the small ones because they add up.
Hmm. Gotcha. Okay, next question is, since 2025 is expected to be a record year, the company will be facing tougher year-over-year comparisons in 2026. Could you share what kind of average long-term growth rate you were expecting?
Yeah, honestly, if I could predict that, I would probably have a different job. I just don't know, honestly, and I don't want to mislead anybody.
Yeah.
What I will say is I'm very focused on making sure 2026 is as good as 2025 or better. That's really our focus, and we really haven't got into our budget and planning cycle for 2026 yet. That happens for us more in October, November timeframe. But I really like our chances, right? Like we've talked a lot about the North Carolina project. That project has sort of been a forecasting nightmare for a long time for us, but
Mm,
now we're on site, we're pouring product, it's adding revenue in Q3, and that project is about a year long. So it's going to run into 2026, which sets us up really great for 2026. We had a large tunnel job that was slated to go in Q4 that has moved into 2026. That's probably about 5 million US dollars. So that's in 2026 revenue. We've got lots of good stuff on the books, and I think once we get through the North Carolina project and the tunnel grouting project, our backlog is going to get more like one times revenue,
mhm.
which I think is a more sustainable sort of positioning. We've had backlog that's been almost two times revenue for a while, and that's because we've had these two large projects sitting in there for a bit. But I
Yeah.
feel very confident about this year for sure and 2026 for sure because I know what's going on and I know that a good chunk of the revenue is contracted or is already underway.
Mhm. Gotcha. Okay, Rahil, another question from Rahil. It says, I understand the company does not provide formal guidance, but based on my analysis, I'm projecting approximately 58 million in revenue and 8 million adjusted EBITDA for fiscal year 25. Would you consider these assumptions to be within a reasonable range?
Yeah, I can't comment on it, Paul. I don't want to mislead. Like I think and it's hard to say, how those
Yeah.
have been built. But I will say, our analyst, Russell, has put out some projections that the company feels pretty confident in.
Okay. Good. Good. That's the nice thing about analysts. You can always sort of point to them and say, hey, they've done their work. Let's work with
Ex-
that.
Exactly. Yeah.
Exactly. Yeah. Okay. So next question is from Chris. He says, what valuation metrics would you consider for future acquisitions?
Yeah, so I mean, I use the ones that I tend to talk about, right? So I look at revenue, some multiple of revenue. I look at multiples of adjusted EBITDA, and we look at discounted cash flow. It's not an exact science, especially when you're buying smaller companies. If you're buying very large companies, I think it can be more of a mathematical exercise. With
Mm,
smaller companies, it's a bit of give and take, right? It's how bad do they want to sell and how bad do I want it? And sometimes
hmm
we might push a little bit on the multiple, but I think that's how we think about it. And in
hmm
particular, we think about it from an EBITDA multiple.
hmm And what kind of synergies do you get when you buy these type of companies? Is there any, I mean, do you have extra buying power? Do you have to, is there systems that usually can sort of disuse and yeah, what savings can you make out of these acquisitions?
Yeah, we don't generally get a lot of synergies when we buy the companies.
Hmm
Sometimes you can take out the owner maybe who might be an
hmm
absentee owner or like part-time, he's just there for
hmm
the big decisions.
hmm
So there can be a little bit of savings at the top, but often we actually have to invest in the companies because when you buy
hmm
private companies, they're really focused on cash flow for the owner, right? That's
Yeah,
that's king.
yeah,
They don't care about revenue growth.
sure.
They might not care about the quality of the office. They might not have a great benefit plan. So sometimes you actually have the opposite. You have to invest in those businesses. So for us, the opportunity is more about market penetration and adding more revenue, which helps us just cover the fixed costs, which makes the
Hmm.
overall entity more profitable. And just the bigger you get, the more things that got to go through you, right? And so
Hmm.
that's how we think about it.
Hmm. Now, you do business on both sides of the border. Tariffs, any kind of impacts that you're seeing through the issues around tariffs?
Yeah, it's interesting. When I think about tariffs, I always thought about it from the viewpoint of Canada-US border, and we
Hmm.
don't really have almost nothing for us crosses that Canada-US border. Occasionally, we'll buy some parts related to
Hmm.
some of our equipment that might be specialized and only come from a US manufacturer or only come from a Canadian manufacturer when we're
Hmm.
working in the US, but it's very rare. Where we have seen maybe some tariff impact is actually if the U.S. puts a tariff on Greece and some of the cement
Hmm.
from the southeastern U.S. is imported from Greece or
Hmm.
Turkey, right? And so we have seen a little bit of cement pricing impact for tariffs. But the good news is most of our projects, we lock in a cement price before
Yeah.
we win that work. So we really haven't had a lot of exposure to tariffs, and I really don't expect a lot of exposure going forward.
Gotcha. Okay, here's a question from Paolo. He says, I understand that management salaries are approximately 1.5 million across four individuals. Has the board or management considered any reductions in these amounts? From what I've seen, compensation levels at many microcap companies tend to be lower. So I was wondering if Randy could share any perspective on this. I ask this respectfully and with genuine interest in understanding the approach.
Yeah, it's
Always
it's
a
a
sensitive issue.
Yeah, but I don't find it that sensitive. I think it's a very fair question. One of the things that we've done that's maybe less obvious in the financials is we used to have four senior executives, right? There was Jeff, myself, MJ, and Jordan. But that really was just a temporary situation as we basically put me in the chief operating officer as part of a succession plan. Yeah, going forward, it's just going to be myself, Jordan, and MJ. You're going to cut that by 25% just based on the numbers. And the guy we took out was the most expensive guy. And so
Mhm.
that's the other reason. One of the things I find a little interesting about the disclosures in those things is when we disclose a bonus payment, the bonus payment's made in the year after. So the
Mhm.
2025 management information circular has our compensation, but it shows basically a bonus that was paid, but it really relates to the prior year, right?
Right.
So it's kind of a long-winded answer to say I think the base salaries we have are not that high, really. The compensation is supposed to be pay for performance. So if the
Mhm.
company does well and meets its objectives, then the executives get paid well. And we've reduced the senior executive count by one, which I think is going to have a significant impact on the cost structure of the company going forward.
Fair enough. Perfect. Okay, Chris asks, based on Randy's research of other similar companies, what is a fairly priced valuation metric for this sort of business?
Yeah, I mean, I'm not an investment banker or an analyst, so I'm not sure. But like one times revenue, 1.5 times revenue, I think are ranges I've seen. 8 to 10 times forward adjusted EBITDA are ranges I've seen. And again, I think it's better to direct those questions to an actual analyst who has the CFA designation and can better explain it. But those are ranges that I think are possible for us.
Hmm. Hmm. And I agree with you. I think, Russell, who I know very well, is a great analyst, and I'm sure we can get a copy of that report and we'll see what the comparables look like. They love to throw in comparables to make their life easier.
Yeah.
Okay, one more question from Rahil, and then we'll work to wrap up here. Rahil says, is company seeing any benefits of graduating on the TSX from the TSX.V? Is the higher listing cost on TSX worth it, do you think?
Yeah, it's a really good question, right? Because it's hard to quantify, are we seeing
Hmm.
benefits, right? I mean, most people always go back to the most core measures. Is the share price higher? And the
Hmm.
share price definitely isn't higher since we graduated. But
Hmm.
that to me doesn't really have anything to do with the TSX graduation. It has all to do
Hmm.
with how we communicate in our business results.
Hmm.
So I do think it's worth it. I think people believe that the compliance costs difference between the TXV and the TSX are like multiples higher, but they're not.
Mm,
They're actually very, very similar. There's a modest increase in the fee you pay to the TSX. I think that difference might be like $10,000. So
mhm,
it really isn't a huge investment. The bigger investment is just to become public, right? Becoming public
mhm,
has a significant investment you got to make in your compliance
mhm,
infrastructure to be able to do that. So no, I truly believe graduating to the TSX was very important for the company, and at some point in the future is going to pay very significant dividends.
mhm. It's a great, I thank Rahil for asking that question. I think that's great to ask that of a CEO who's dealing with it straight away. So that's perfect. I appreciate that. So Randy, so looking forward as investors, what do you think we should watch as either sort of the metric that makes the most sense, or maybe a catalyst or something like that, as far as, how the business is performing? What should we pay the most attention to?
Yeah, I think for the most part, investors got it right. And I'll tell you, I'm measured on four things as the CEO. So we have a scorecard in place. And so one is revenue, right? And obviously growing revenue is super important. The second is margins. How are we doing on the profitability? The third is the bottom line. So EBITDA is EBITDA growing. And then the fourth is cash flow, right? So when I look about how's our business doing, I look at those four metrics primarily, and I measure those to say, how are we doing against those? And that I know if I can make all of those metrics better, the share price will follow, right? And that's really what we're focused on, and we're trying to demonstrate our words through actions, right? So
Hmm.
when we produce the financials, we're trying to be very honest and transparent about what we see happening in the business, and we're hoping that those financials back up what the messaging that we've been giving to investors.
Hmm. Well, listen, Randy, first off, great job for a first timer at CD here. I appreciate what you've done, and I think you did a great job. But is there a key message you want to make sure everybody walks away with today? Is there something we may have missed, or is there just something you want to really make sure everybody understands?
Yeah, I would just say the key message for me is I'm really excited about our company and the prospects in front of us. I just think it's a really great investment opportunity. Like you have to have a bit of a different focus. I know like nowadays people are more interested in AI or cryptocurrency or minerals or gold, right? All the sort of in fads. But if you're looking outside of those and you're looking for something different, something more a little more stable and safer, I like construction because construction once you get above a certain size is pretty dependable, pretty predictable. And if you know what you're doing and you don't take excess risk, it's pretty consistent to make money. So I just really think it's a great opportunity. I really feel like our company's undervalued, in part because of things that we've done in the past where we haven't met our commitments, but also in part just because we're not one of those new sexy industries where you could get a 10 bagger in 3 months, right? You're not going to get that in Cematrix. But I think if you're a long-term investor and you're looking for a stock that's maybe been overlooked, I think we're a really good opportunity and we should be of interest to you.
Hmm. This is not meant as an insult, but we find boring is beautiful. Businesses that are consistent like this, we love them. So you don't have to be too sexy to get us excited. But this has been great, Randy. Thank you so much for joining us today. We've been speaking with Randy Boomhour, CEO of Cematrix. Symbol again, CEMX on the TSX Venture Exchange, CTXXF on the OTC. Randy, once again, thank you for joining us, and look forward to the next time we can catch up.
Sounds great. Thank you so much for having me, Paul. I really appreciate the opportunity and yeah, enjoy the rest of your day.
You got it. Bye for now.
Take care.